Guys, wanted to update a story we've been following for some time, which continues to worsen for the giant Swiss wealth manager Credit Suisse, obviously also an investment banking firm here in the United States, certainly known under the CSFB or CS, soon to be perhaps First Boston moniker. But the specifics that we've gotten out of Credit Suisse and what they're calling a updated outlook for the fourth quarter are perhaps concerning for people, in part because of the loss of assets at the company that was, I am told by people close to the situation, far above what had been anticipated. You may recall, of course, some time back, the company announced its plans to raise as much as $4 billion in equity. The Saudi National Bank, a large family in Switzerland, the Qataris, amongst those that were signing up for that $4 billion. But despite that announcement, and with the thought being perhaps the announcement would be enough, it was not enough to stem what has been a very significant and continued number of outflows of assets. Let's give you the numbers themselves, because Credit Suisse did share the basics with us, right? They're expecting a $1.6 billion loss for the fourth quarter, but the outflows are what is key here. 6% group AUM. So as of at the end of, as of November 11th, net asset outflows were about 6% of assets under management at the end of the third quarter of 2022. In wealth management, those outflows, they say, were reduced substantially from elevated levels in the first 2 weeks of October, but have not yet reversed, and were about 10% of assets under management, again, at the end of the third quarter. You're talking about $1.6 trillion in total assets, something around those levels. 6% of that, you can do the math. We're talking significant numbers. And why is this important? Well, is that $4 billion in equity raise going to be enough, is the key question. And it would seem perhaps no longer is that going to be the case. The market certainly may have sniffed that out already. You've seen what's happened to the stock price over time. But when you are in the business of trying to keep yourself investment grade rated, and you're simply trying to fill a hole here that is worsening as a result of the loss of assets and the fee income that comes along with them, well, the number that you need to raise in terms of equity, not just to keep the rating agencies happy so that you maintain investment grade, which obviously is vitally important, but also so that you can retain important employees and have the packages in place to do so, and actually have the growth capital you need for your business, because remember, they're talking about this not being profitable for a couple more years. That's where it becomes more concerning. And so we're going to keep a close eye on it. When it comes to the profits or lack thereof, the company also told us, together with the adverse revenue impact from previously disclosed exit from non-core businesses and exposures, they will expect the investment banking group to report a substantial loss before taxes in the fourth quarter, as much as 1.5 billion in Swiss francs there. You can see for the group overall, they're maintaining their ratios, but they did hit liquidity buffers, and they had to utilize those liquidity buffers at the group and legal entity level, and they have fallen below as well certain legal entity level regulatory requirements. You know, Mike, these are always interesting scenarios, because you announce a capital raise. In part, you're trying to stem, or you're trying to bring confidence to the market. Right. If it doesn't work, more assets leave. Yeah. You raise that. Is it going to be enough, or are you in a negative spiral where you can't simply get ahead of it in terms of imparting enough confidence to the marketplace to stop entirely the asset losses?
I mean, the bet by the company was that they had a strong enough core franchise in asset management and wealth management that there was going to be a more steady base. Now, the $4 billion expected capital raise, I mean, what is it, under $10 billion equity market cap?
That is correct.
Right,
it's around $9 billion.
It's a very
now.
big.
It's enormous dilution, but the fact is that it would appear, based on the conversations I've had, that it's not going to be enough at this point, if in fact they really want to, as they certainly do, get ahead of this. And maybe, we'll see. But the key is for them to restore confidence. I don't know what the number is. Perhaps they don't know what the number is. Right now it's $4 billion. That's what they've got approved for. They've got the investors lined up for it. But to your point, the dilution will be massive.